What is up, everybody? Good Monday morning to you. Welcome to the Monday Mortgage Markets meeting. I am Sean Grapevine, your host, a co-branch manager of the Atlanta branch. And I'm joined here this Monday, as with every Monday, by the one and only, by the legendary, the Sultan of SWAT, the Baron of Bips, the Titan of the 10-year, the man who likes his Philly with extra cheddar, the one and only Austin Koenig. Welcome, Austin.
Thanks, Sean. I appreciate the illustrious intro as always. Thanks for hopping on with me. And, I think we walk into the office today with a lot different rate picture than, our post-Fed meeting that we had. It's a special edition market update. Things have changed quite a bit since we've met.
Yeah, what the heck, man? Good news is bad news. Bad news is good news. What's like? Why is the 10-year at 3.6 this morning?
Well, I think one thing that we talked a good amount about when we were meeting on Wednesday was, the Fed, again, while they speak with very vague terms a lot of times, data is very important to the Fed, right? And kind of their decisions. We got a very important piece of data on Friday, which was the non-farm payroll number essentially, and that was a big blowout number. What we got 517K, and we were expecting around 200 roughly. So let's say, it was well over double what was expected, which caught the market by surprise.
Yeah, and they revised up November and December significantly as well, right? So it was insult to injury. Now tell us like why the market hates the lowest unemployment rate in 44 years.
So the reason why they hate it is it's two things really. I think so when we're thinking about an economy that is heating up, or an economy that allows the ability to kind of absorb increased prices or continue to have increased demand. That's an economy with a good, strong labor market where people are making money, where people have jobs, and if they don't have a job, they're able to get a job.
And we hate that. And we hate that for some reason. And this
we hate
upside
that
down
if we
we now
want
live
if
in.
we hate that if we want to have monetary conditions ease, because they're not going to ease from a place of, hey, everyone's still able to buy the goods that they need to buy, essentially, right? So, and that's what drives inflation. So the reason why we don't love it, why we don't love it, is because we think the Fed can act on this data, because where we kind of landed during our time where we're talking after the Fed meeting was, it's like there's a gap between let's say you have 60 to 40%, maybe you think there's a 25 bip hike coming down the road, something that there'll just be a pause for the next meeting. I think that kind of gone towards more people are thinking there might be another 25 bips rather than not, with just that one piece of data, right? So that doesn't mean that it for sure happens, but I mean that jobs number was a very good notch in the belt, or something that the Fed can put in their holster of like, hey, the economy's still hot in this area. Like, we can't let off the gas quite yet. Is the way they can kind of justify that, right? So whether you like anecdotally think about, does this actually make sense? This number makes sense, or is this number kind of an out of touch number compared to what actually is happening in the economy? That's obviously all well and good. You can have your own speculation, but the thing is this is what the Fed treats as truth. This is what the Fed uses in economic decisioning, and we would love to see how the minutes come out, because we kind of we talked a little bit about this with what Jerome Powell was saying. The minutes of what they discussed in their meeting last week comes out later this month. So it'd be great to see if we can kind of get some clarity behind, okay, well, what's the path forward? What if we get these kind of jobs numbers? Like, how do we conceptualize that if inflation continues to show signs of slowing down? That's kind of where we need to be able to put two and two together, I guess you could say, if there is the ability to. So that's kind of what I'd have to say, is what we have to look forward to. And obviously inflation, like I mentioned, comes February 14th, Valentine's Day, not this Tuesday, but next.
Okay, so we've got till next Tuesday to hear some other like big needle moving pieces of news. And so we've had 3 good inflation prints in the last 3 months, and they've been met with acclaim. And if we have a 4th one, right, like people are going to start assuming like, all right, we're getting over this. Like, when does the market start believing in a soft landing? So right now it's like, oh no, inflation's down to 3.4%. Like, what are the chances we're going to have a soft landing if jobs numbers are through the roof, right? Like, inflation's going to keep going up, but like if inflation keeps going down, but jobs numbers stay, super healthy, it's like, guys, this is what you wanted. This is the golden goose. This is the unicorn. Like, we never thought it was going to happen, but like we've had 3 good jobs numbers in a row, and then 3 good inflation prints in a row. I'm like, when does the market believe in the soft landing?
I think that's a good question, Sean. I actually don't know when the market can believe in it. I think everyone has to work together to conceptualize as soft landing as possible. I think the market generally thinks it's more and more possible, but it depends on what the Fed does, right? Like, if the Fed doesn't allow for a soft landing, they kind of push to a hard landing with very high interest and very restrictive policies. That might just be taken out of equation. Like, to be perfectly honest with you, that's kind of where does restrictive monetary policy meet, kind of letting the status quo figure itself out. I think that's kind of where we have to decide, what is the true case that we're going to have, and how long are we going to be at this, how long and how high, right? We've kind of talked about that a while. So I think these are the things that the market would love to have a soft landing. The thing is do we solve for inflation longer term with a soft landing? Does the Fed think they can do that? There's so many factors.
Is there any like, modern American precedent for a soft landing? Have we? So I guess we've really only had 2 big inflationary moves in the past that we've tried to solve with monetary policy. It sounds like, right? Like this one and the 70s and 80s. And the 80s was not a soft landing, but it wasn't a hard recession. It's kind of the sense I got, right?
It was a bumpy landing, but with all that being considered, it wasn't like a landing that set up for a prolonged recession, right? And actually, the thing is the economy was set up to really do well later in the 90s, essentially, by kind of those policies, I'd say. So I think generally there's not like a perfect precedent to what we're going through right now. There's not. Like, it kind of takes a lot of different, because there was a slight tiny recession technically within right after COVID, right?
Right.
And so that was very unique. And on the next part, it was the unique part is the Fed was going out and flooding the market with cash very quickly. Kind of taking unprecedented monetary policy outside the financial crisis in 08. But the financial crisis in 08 was a completely different ball game that we're playing than what we're in today, just generally. So there's so many different factors that kind of makes it uncharted waters, I think, all things considered. But I'm not a perfect economist historian by any means. I don't know every single thing that that kind of goes along with these things. But at the end of the day, it is unprecedented. I would say multiple factors. So we're kind of on our own here. We'll kind of have to see is anything that they're doing right or anything that they're doing wrong. I think it'll all be hindsight 2020, because that's what is the study of economics. It's always backward looking.
Right.
Anyways.
Yeah. Yeah, except for when you're running a capital markets desk, and then you got to be able to see 30 days into the future.
Yeah, you hope so, right?
So what are your well, before I ask this question, I think it's the UMortgage party line is don't make locking decisions based on what anybody ever tells you they think is going to happen in the next couple of weeks. When it comes down to it, if you like it, lock it. We have the best float down policy in the history of the world. It's called 20 lenders. So, as much as it sucks to pull a deal from a lender when rates go down and put it with somebody else, and we really want to value those lender relationships, like when it comes down to it, we're going to make the best move for our clients and make the best move for client retention. Make sure we're doing the loans for our clients. If you think that rates are going to come down in the next 2 weeks, that's great. But if you have a deal today, go ahead and lock it. And if rates float down, you can either renegotiate with your current lender or pick a new one. That being said, disclaimer over. Austin, what are your thoughts for? I mean, we've just seen the 10-year smack right through 3.62 again, right back where we started. After every piece of good news we've had for the past 3 months. Sorry, not to sound bitter. What are your thoughts for the next 2 weeks once CPI, the CPI comes out? Is it going to provide some relief to the market?
Yeah, I think CPI could help provide some relief, but with all things considered, there's other pieces of data that the market will try to grab at. I would say, like, there's initial jobless claims. Seeing how those come out will be important. We also will have Jerome Powell speaking even tomorrow. Like today, there's not really any data. It's kind of a quiet day, I would say, on the Western front here. But we have Jerome Powell speaking tomorrow. We also have other Fed speakers later in the week, and also just what other governments do. We even have University of Michigan consumer surveys at the end of the week on Friday. There's a lot of things that can move the market. We still haven't even talked about the the impending debt ceiling raise that we need to happen as well, right? So there's a lot of other things that can move rates around. I would just generally say, Sean, you kind of hit on it perfectly. Like, rates are down from the peak. I think people are coming into the market, and this is approaching affordability is a little bit better, right, than where we were in like October, November of last year. So I think without really looking in too deep into the rates, lock it is a good way to kind of go about these things. And when it comes down to rate locks that we have to move elsewhere because of big volatility moves, that is a decision that has to be made, but it has to be made with the right mindset, right? We don't need to make anything too rash. We have to think about every deal very coherently. We have to think, okay, what is this deal right now? Like, is it the day before closing? Like, there's not really a way to kind of position things. We need to look at when we did the lock, what's this kind of deal? Who are we doing this business with, the investor and everything like that, and just kind of think about everything except and rate is just one part of the piece. So we just need to kind of think about this at a very holistic view, and we will be along for the ride, as long as you're in the mortgage business, but especially until we can kind of get further clarity. I would just say generally too, volatility is not as bad, I would say, as we are in this kind of window of like a certain range. And we kind of know it's just a matter of how much more, and it's not too much more of rate hikes. It's just going to be, the market deciding and pricing in different things that comes in through data. And that's kind of what we've been operating in the whole time. So I think it's just, we're kind of getting to the end of this. It's just a matter of let's continue to play what made us successful earlier. We just have to continue to kind of, come each day and attack and lock it.
There you go. You heard it. You heard it from the man, the myth, the legend himself, the primary man on the secondary desk. Austin says, if you like it, lock it. He doesn't mind moving it to, or asking a loan coordinator to move it to a new lender if we have to, when and if rates go down during the process. So a couple pieces of economic news this week. Should be kind of a slow news week. And then next Tuesday is all about CPI. I'm excited for it. I love the CPI print. I don't know why. It just feels like such a hefty number. Like it really means something. And it's been good the last 3 weeks, so I'm all about that. So we'll let everybody get back to liking it and locking it. Austin, thank you so much for your time.
Of course. One last thing before we go.
Yeah.
Just generally, one thing with CYP right now, everything everything you've seen with CYP. Anytime you have a CYP request it to the lock desk at UMortgage. We're applying it directly with UWM. So we'll do that for you guys, going forward. So just make sure if you have a CYP request, send it to the Lock Desk Mortgage, or just make sure to include us if you have any questions. All right.
And, well, okay, so when we're building out the fees worksheet inside of Arrive before we hand it off to submissions, should we factor in that 40 bips credit into the discount point? Should we manually subtract 40 discount points, or like allow the, like, when in the process should we do that on our end?
Great question. I think at the NLBL, what you want to request, you can go in and account for it, but just make sure obviously that is very clearly noted.
Right. Yeah.
That the reason why this number is because I'm applying 40 bips to CYP or 20 bips or whatever the case is, right? So that's my only point of emphasis there, is just make sure you're clearly saying CYP.
All right, you got it. We will do that.
Cool.
Thanks so much, Austin. We'll see you next week to get ready for a big CPI print. Thank you, everybody. Please, in the comments, let us know if you have any questions. And once you're done with that, go lock some loans. Thanks, everyone.
Awesome. Thanks, guys.